Good evening. Welcome to Ekcel Academy's live session of financial management revision. I hope I am audible, and also I'm hoping that the video is clear enough for you to see the paper here. So before we proceed further, let me quickly tell you about Ekcel Academy. So you can obviously visit our site, that is www.ekcl. Okay, let me just open that first. Anyway, we have been teaching for company secretary course since more than 10 years now, and if you haven't already registered, I would suggest please visit our site, which you can see on the screen, and register there, because there are certain things which are not available on the YouTube channel. So if at all you want to take advantage of those things, maybe some notes, free videos which are there only on the website, I would suggest please do log in. It's a free thing, you don't have to pay for it anyway, so just check it out. So if you are interested, you can then call us, and if you have any queries also, please do call us. And the links, the phone numbers, everything is there in the description below this video. So yeah, that's about it. Let's get back to our paper. Where is that now? Yeah, so this is the December 2019 question paper. Of course, I don't want to read out the instructions. You already know, in the previous session also we did the same thing. So every 4 negative answers will make you lose 1 mark. That means each negative or each incorrect answer will fetch you minus 0.25. That means whatever you have scored from that minus 0.25 will be deducted. So be careful while you are attempting the questions when you have negative marking. Okay, so now let me just import this into a software first. Okay. Now let us look at a few of the questions here. Why I said few is because we won't be covering the entire paper today. This will be a shorter session compared to the rest of the sessions. In the previous session, we looked into December 2019 accounts CMA paper. So there I think we covered about 25 to 30 questions. So the next part where we will be continuing from there would be tomorrow at 4 o'clock, Saturday 4 o'clock. And today we are looking at FM. Here also we'll be looking at 20-25 questions. I believe it would be advisable to restrict in one session just to about 20 to 25, and we'll take it up in the next session. And one more thing which I would suggest you to do while you are solving these type of question papers, that is the past exam question papers, don't just look at the correct answers, also look at the incorrect answers and try to understand why that particular answer is not the right answer. So that way, if at all a question is asked specifically with respect to that particular option, which is the incorrect option for this question, then you will obviously know how to answer. So just don't look at the right answer and proceed further. So that's the gist of what I wanted to tell you. Anyway, let's look at the first question now. Which of the following is true regarding the financial decisions of a firm? Okay, one more thing, if at all the audio is not clear, if the video is not clear, please do ping me on chat. I'm anyway monitoring the chat here. Which of the following is true regarding the financial decisions of a firm? Okay, they have emphasized on the word true. Which of the following is true? Okay, first of all, we'll have to look at all the options. Let's start with first one. Investment decisions are dependent on financing decisions. Financing decisions are dependent on dividend decisions, and dividend decisions are dependent on investment decisions, and all the three decisions are interrelated. So of course, when you look at these three, that is what we get to know, that all the three decisions are interrelated. But how? See, investment decisions involve determining how a firm will allocate its resources, let's say to acquire long-term assets and investments, and these decisions require capital, which can be obtained through various financing options such as debt or equity. See, the availability and cost of financing options influence the firm's investment decisions. Now coming to the second option, that is financing decisions are dependent on the dividend decisions. Now, what does these financial decisions or financing decisions involve? These involve determining how a firm will raise capital to finance its operations and investments. The dividend decisions, on the other hand, involve determining the amount of profits that will be distributed to the shareholders as dividends. The dividend decisions affect the retained earnings of the firm, which in turn impacts the financing decision. See how one thing affects the other. For example, if the dividend payout ratio is higher, it will result in lower retained earnings because we are paying more of earnings as dividend. That means our money, whatever we have, will be less. So then if the money which we have is less, then we'll have to rely more on external financing. So that is option 2 or option B. Then dividend decisions are dependent on investment decisions. How? See, dividend decisions are also influenced by investment decisions, because when a firm undertakes profitable investment projects, it can generate higher earnings, right? And also higher cash flows or more cash flows. So this increased profitability will provide the firm with more funds so that it can be distributed as dividends. Conversely, if the firm has, let's say, limited profitable investment opportunities, then it will obviously, instead of investing, it will retain the earnings for future investments rather than paying out those retained earnings as dividends. So in summary, what we can understand is all the three decisions, whether it is investment, financing or dividend decisions, they are all interrelated and influence one another with respect to financial decisions of a firm. So therefore, option D is in fact the right option. I hope it makes sense. Okay, Naseem Hashmi has already answered correctly. That is option D. You are correct, Naseem. That is the right answer. Okay, next one. One second. Okay, what will be the maturity value of a sum of rupees 18,000 invested today at the rate of 5% per annum for the next 10 years? Okay, so this is a practical problem, but it's not a very difficult problem. Simple, straightforward sum actually. Maturity value of something which is invested today. That means present value is 18,000. And we will invest this at the rate of 5%, very low rate of interest anyway. For how many years? For 10 years. In that case, what will be its value? For example, in this case, what we can do is we can just calculate the future value by considering 1 plus, what is the rate here? 0.05, right? To the power of 10. So now, whatever we get here, that if you multiply by 18,000, then you will actually get the present value of that 18,000. Once again, what is that they have asked? What will be the maturity value? That means what value will we get at the end of 10 years? So now future value is easy to calculate. 1 plus r to the power of n. R is how much? Rate of interest 5%. So I have written it as 0.05 here. And n is how much? That is the duration, 10. So when you do that, for example, if I have to bring up the calcing, 1 plus 0.5 into 1.05 to 1.05 to 1.05 to instead of that, we can just directly go to the table also. So from the table, let me just try to check the value. Table. Just a second, guys. Okay, I'm not able to access that anyway, doesn't matter. Into 1.05, 3, 4, 5, 6, 7, 8, 9, 10. Okay. So this is the value. Multiply by 18,000. You will get 29,320. That's it. So in the exam, I am not so sure whether they will provide the table or not. If they provide the table, well and good. Otherwise, you will have to do the way I did right now. So what I did was just use the formula here. Let me just insert a new sheet so that I can explain it clearly. Future value or the maturity value is nothing but 1 plus r to the power of n into the multiplied by the present value of investment. So now present value of investment is easy, that is already known, 18,000. Then what about the r? R is nothing but the rate of interest, which is 0.05. N is 10. So when you do that, you will get 1.628894, whatever. I'm not rounding it off, but you can round it off later on, multiplied by 18,000. So when you do that, you will get result 29,320, which is nothing but the present value of this, or rather the future value of this investment, which is also the maturity value. So option, which was that option? Option D is in fact the right answer. I hope it is clear. If you have any doubts, please do ask. That was actually fairly easy. You don't even need the table. I thought we can use the table, but anyway, I'm not able to access it. In the exam, if the table is not given, just raise 1.05 to the power of 10. That's all. It's not very difficult also. Option, yeah, C, correct. So now let's move on to the next question, which is the third question. Let's read the question first. The competing objectives of financial management have been, okay, profit maximization and wealth maximization, profit maximization and economic value maximization, economic value maximization and wealth maximization, and EPS maximization and economic value maximization. Okay. So these are the 4 options, but this is a very popular thing. We already know what is the answer. Option A is in fact the right answer. That is profit maximization and wealth maximization. That is always the objective of financial management. See, wealth maximization, however, is actually considered as a broader and a more comprehensive objective compared to the narrow profit maximization. Profit maximization mostly focuses on maximizing the profits of a company, say in the short term. The goal is to generate as much profit as possible by increasing the revenues and minimizing the costs. This objective, correct, is there, but it is relatively straightforward and emphasizes the financial performance of the firm in the short run. Whereas wealth maximization, on the other hand, takes a long-term perspective and aims to maximize the wealth of the shareholders. It considers the time value of money and takes into account the risk associated with the investment decisions. Wealth maximization also focuses on the increasing the market value of the firm's shares over time by making sound investment decisions and generating sustainable profits. So between the two, obviously wealth maximization takes more importance, or it takes more precedence. Whereas the profit maximization also is important, but not as important as that. But when you look at all these options, obviously option A is the right answer, which is profit maximization and wealth maximization. But between that, wealth maximization is more important for any firm because profit maximization is a short-term thing. Okay. Anyway, that's about option 3. Good thing is you don't have to explain any of this. The moment you look at the right option, all you have to do is just tick or select the right one. Naseem Hashmi has been answering correctly. Good. Indeed, that is the right answer. Next one. Which of the following is an example of systematic risk in stocks? Okay. Company strike, industrial recession, unexpected entry of a new competitor in the market, bankruptcy of a major supplier. So we have 4 different options. So now the question here is about systematic and unsystematic risk, because this again is a straight lift from the study material. If you have read the study material, you can easily answer this. So the answer in this case is industrial recession. We'll see how. Systematic risk, first of all, we should understand what it is. No, systematic risk is also known as market risk or non-diversifiable risk. That means it refers to the risk factors that affect the overall market or a particular industry. Okay, it is beyond the control of individual companies. A company cannot do anything about the systematic risk. It affects the entire industry. Maybe let's say, imagine 50 years ago, all the movies were shot on film. Every movie company would shoot, there used to be companies back then, and they would shoot on film, physical film. Now supposedly, if there was a shortage of film in the market, then they would not be able to shoot the movie at all. So imagine, in this day and age, it is mostly the memory cards. Imagine there are no memory cards at all. Imagine there are no hard drives, there are no SSDs. In that case, how do we even shoot? Then it is not just one particular company which will be facing this risk, it will be the entire industry. So that is a systematic risk. So now, among the options provided here, the industrial recession is an example of systematic risk. Now, what is this industrial recession? It refers to, let's say, a downturn or economic slowdown specific to a particular industry. In fact, it's a macroeconomic factor that affects the performance of the overall industry and also the profitability of companies which are operating within that industry. Let's say during an industrial recession, companies in the affected industry will obviously experience lower demand, reduced sales, declining profits, which will obviously impact the stock prices. Okay. For example, the other options here, that is the company strike. This is not a systematic risk. This is an unsystematic risk which will obviously affect that particular company only. Or even this bankruptcy of a major supplier. This is also specific only to this particular company. So now there is one more option, which is unexpected entry of a new competitor in the market. So this, you can see it's a combination of both the systematic and unsystematic risk. See, while the entry of a new competitor will have impact on specific companies in the market, it can also have broader implication in the industry as a whole. The best example which I can think of is Jio. It's obviously impacting not only certain companies, in fact, Airtel got impacted, Vodafone, Idea. There are so many different companies which got impacted. And also at the same time, we had broader implication for the entire industry as such. So therefore, this is not a proper example for systematic risk. So the the perfect answer here is industrial recession. I hope it makes sense. If you have any doubts, please do ask. Okay, Priyan and Saranya have answered correctly. Correct. Okay, good. Let's move on. Next. This is actually easy. I don't even have to explain this. Let me see if you can answer. I'll just wait for a few seconds before you answer this. Treasury bills are issued by dash. All of you have answered correctly. It is indeed the central government. Okay. See, treasury bills, are also known as T-bills, are what? Short-term debt instruments issued by central government of any country. And they are typically issued to, let's say, meet the short-term funding requirements of the government. So it is considered to be one of the safest forms of investments. Why? Because it is backed by whom? It is backed by the government. And their credit worthiness is something which you need not worry about, because we know once the money is with the government, you'll always get back. At least they're the most trustworthy investment opportunity. But the problem there is the interest rate, or whatever the returns which we will be getting out of that treasury bills, will always be low. So higher the risk, higher will be the return. Lower the risk, lower will be the return. So that is a classic example of that. Okay, so there is nothing much to do there. It's a straightforward answer. Next. Okay, here is a problem. Given the effective rate of interest is 9.31%, what is the nominal rate of interest if compounding is carried out quarterly? Okay, so let us solve this. Let me just open a page here. So now the question is asking about, let me just go back, try to copy this. Given, 1 second. Yeah. Given that effective rate of interest is 9.31, fine. If effective rate of interest is 9.31, what is the nominal rate of interest? Given compounding is carried out quarterly, fine. let's try to do this. So now we have to first of all use a formula. Without using the formula, obviously we won't be able to identify. So Rn equals 1 plus Re divided by m to the power of m minus 1 is the formula which we have to use. Obviously we won't get the exact answer, we'll probably get the approximate answer. See, nominal rate of interest is what? It's the stated rate of interest, while effective rate of interest is the actual interest after taking into account the effects of compounding. Once again, nominal rate, stated rate, effective rate, that which you actually get after considering the compounding effect. So in this case, they have given us the compounding or rather the effective rate of interest after considering compounding how many times? 4 times. How do we know it is 4 times? Because they have mentioned quarterly. So now all that we need to do is substitute the values here. Once we are able to substitute the values, we can easily identify how much is the actual effective rate of interest, nominal rate of interest. So now, first of all, let us try to understand what is what. So Rn is what? It is the nominal rate of interest, which we do not know. Okay. Re is what? Re is the effective rate of interest. That we know because it is given in the problem, which is 9.31. Then what else is there? Then we have m. So m is nothing but the number of compounding periods. That's all. So in this case, how many times are we compounding? We are compounding 4 times. So therefore, in our case, it will be 4. Okay. So now if I have to substitute these values, what will be the case? 1, obviously 1 as it is, plus Re is 9.31, or also can be written as 0.0931 divided by m, which is nothing but the number of times it is compounded in a year, which is 4. So this raised to the power of 4 minus 1. So when you simplify this, you will get the right answer. Let us try to do this. 0.0931 divided by 4 will be this much, 1.023275 to the power of 4 minus 1. Okay, 1.023275 into, okay, let me just memory into okay, what I did was I just saved that in memories. That way it will be easy for us to multiply. Even in exam you can do that. Instead of typing the entire thing again and again, you just save it as memory. All you have to do is just multiply by memory recall or recall memory. So that way we got 1.09640 something something minus 1, which will give us 0.96 something 401. So let us look at the options. Basically 0.9. So if you look at the options, we have 9.25, 8.5, 9 and 9.2. We don't have 9.6 no here. Okay. There is no problem in the formula. Formula is correct. Effective rate of interest, whatever we have written down is also correct only. Is there any calculation mistake here? Or what if I add 1 first of all and then try to do this? Let me just try this. 1.093 actually shouldn't be no, that won't fetch us the right answer. 0.96 is what I'm getting, but I don't know why they don't have this option at all. Maybe if we have consider if there is any rounding off error also, sometimes you will get this problem, but I don't think there is any rounding off error because we have considered everything properly. Let me just do this once again. 0.0931 divided by 4 will be 0.023275. That is correct. So I saved it in memory. To the power of 4 1, 2, 3, 4. No, again something. So recall memory plus 1. No, yeah. So this should be raised to the power of 4. 1 second. 1.023275 memory into recall memory into recall memory into recall memory. Again we'll get the same answer. Okay, I don't know why we are getting okay, 0.96. What is the right answer according? Let me just check the institute guidelines once. According to the institute guidelines, the right answer is 0.09. This apparently is the right answer. We'll have to check how they got that. Okay, I will do one thing. I'll take this particular question in the next session as well, so that we can come back and check what exactly or where exactly we went wrong. Let's deal with that later on. Okay, otherwise we'll be spending too much time on that. So that was question 6. Let's move on to the next one. I'm sure there is some problem with the formula. Otherwise we should have got the right answer. Normally institute doesn't make mistake when it comes to exam related questions, but you never know. Sometimes even here they have made mistakes. Let's worry about that in the next session. Just remind me. Okay, let's move on. What else? Okay, theory question. Decisions related to the mix of debt and equity in the balance sheet best relates to which of the following? Okay, this is actually easy. Decisions related to the mix of debt and equity. So if it is about debt and equity, it relates to which one? Capital budgeting or capital budget, capital structure, capital expenditure, or operating leverage. Definitely not option C and D. And option A is also ruled out because it's not just about capital budget. It is option B, which is capital structure. Now how? See, decision related to the mix of say debt and equity pertain to actually the capital structure, right? What is capital structure? First of all, let's try to understand. Capital structure is nothing but the composition of the company's liabilities, specifically the proportion of debt and equity used to finance its operations. See, when we say capital structure, we are not referring only to the owner's capital. We are also looking at the debt which the company has raised to operate. Without the debt, it cannot operate. For example, debenture will also come into capital structure. Okay, so capital structure decision in fact involves determining the optimal balance between debt and the equity financing. So it considers various factors such as cost of capital, the risk tolerance, what is the financial flexibility, the impact of let's say company's overall financial position, and also the profitability. So this is what capital structure refers to. Whereas if at all I have to look at capital budget, that is option A, it is nothing but allocation of funds for long-term investment projects, maybe some acquisition of assets or development of new products. That's all. It is not related to the capital structure. We are only looking about particular investment. Whereas option C, that is capital expenditure, specifically relates to investment in say long-term assets or projects that are expected to generate future economic benefits for the company. So that is about capital structure. And operating leverage is totally different thing, which is nothing but the degree to which the fixed costs are present in a company's cost structure. So it measures, that is the operating leverage measures the sensitivity of a company's operating income to changes in revenue. Okay, so that is what it does. So therefore the right answer in this case is option B, that is capital structure. Let's move on to the next question, question number 8. Which of the following are not applicable in case of payback period calculation of investment appraisal? Okay, which of the following are not applicable, they say. So let's look at the options. It is simple in concept and application. Okay, it favors only those projects that generate substantial inflows in the earlier years. Okay, the cutoff period is chosen arbitrarily. It considers the time value of money. This is in fact very easy. See, payback period is a very straightforward thing. Okay, few of you have answered, but I don't know whether the answer is related to question number 8 or not. If it is related to question number 8, then you are in fact correct. See, payback period is a very simple concept wherein we are looking at when exactly we will get back the money. That's all. We are not worried about anything else. So we are not worried about time value of money, what would be the actual present value of future cash flows. All those things we are not at all worried about. For example, I'll give you an example. Let's say you invest rupees 100. You will be worried about when I will get back this 100. Let's say this 100 is the initial investment, year 0. First year you're getting returns of 25, second year 30, then next year 35, then next year 40. So now 25, 55, this will be 90, then 130. So we are only worried about the payback period. In this case, it will be between years 3 and 4. Done. That's all. We are not worried about anything else. So here in the option, if they say it considers time value of money, it is obviously incorrect. So it is not applicable to what? Payback period calculation, because payback period calculation does not consider time value of money. It only is used to evaluate the time required for the investment to recover its initial cost. It only focuses on what, like we saw in the example, on the cash flows generated by the investment, and it determines the time it takes for these cash flows to equal or to exceed the initial investment. That's all. So therefore option D is in fact the right option. Let's move on to the next one. Question number 9. The security market line shows the relationship between dash dash dash. Okay, let's see. Expected rate of return and beta, fine. Expected rate of return and diversifiable risk. Required rate of return and unsystematic risk. Realized rate of return and beta. Okay. So this, first of all, we have to understand what is security market line. Again, see, the problem with practical papers is it's not just the problems which will be asked. You will be asked theoretical questions as well, because if all the 60 or 50 questions from FM are related to practical questions, then you will definitely not have time to solve each of those. So that's why the institute kind of tries to balance between theoretical questions and practical questions. It is in a way good, but in a way it is also difficult, because when there are certain questions which depends on your knowledge of that, if you have not studied, there is no way you'll be able to answer these type of questions. Okay, so let's try to understand what is security market line. It is nothing but a graphical representation of the relationship between the expected rate of return and the beta of an investment, or let's say security. See, it is one of the key concepts in capital asset pricing model, which if you have studied you will know, which is in fact used to determine the required or the expected rate of return for an investment based on its systematic risk. This security market line in fact plots the different combinations of expected return, and that will be on y-axis, and beta is plotted on the x-axis. Beta merely represents the measure of the systematic risk, or you can even say the sensitivity of an investment's return to the overall market return, how it is sensitive to overall market return. So in summary, what we can say is expected rate of return and beta is in fact the correct choice. So because SML or security market line in fact illustrates the relationship between these two. Okay, so as I said, one is plotted on the x-axis, the other is plotted on the y-axis. Which is plotted on the y-axis? The expected rate of return, and beta is plotted on the x-axis. So that relationship is what is understood through security market line. Okay, I hope it makes sense. Let's move on. Sharanya has answered correctly. It is indeed A. Next. This again is not very difficult. Let's see. Question number 10. The cost of retained earnings. Again, there is one misconception. First of all, we have to clear that retained earnings will not have any cost, because it's already there with us, right? If it is sourced from some outside entity or maybe from bank, financial institution, then it will obviously have a cost. If you are issuing shares, it will have a cost because shareholders will have some expectations. If you are issuing debentures, then there will be debenture interest. If you are borrowing money through loans, then there will be loan interest. But if you are using your own retained earnings, then there is no question of any cost, right? No, there will be a cost, because the the first thing which actually comes to my mind is the opportunity cost. If I don't use this for my own projects, I would rather invest it elsewhere, right? Let's say I have some 100 rupees. That is my retained earnings. If I do not use it for my company, maybe I will invest it elsewhere. That investment will actually fetch me return. So there is obviously some cost here. Okay. Anyway, so now here, first of all, let us look at what is what? Dividend payout ratio. What is this dividend payout ratio? It is the ratio which is talks about the proportion of earnings that a company distributes as dividend to its shareholders. It does not represent the cost of retained earnings. It has got nothing to do with the cost. Okay. Then comes option B, which is rate of return expected on the equity share. So now what is that? See, this cost of retained earnings in fact refers to the return that the shareholders expect to earn on the equity shares of a company. As I said, it represents what? The opportunity cost of retained earnings. That is, what would the company have done if they do not invest or if they do not plow back the funds which they've already earned? Maybe they would have distributed as dividend. If the company had distributed the retained earnings of the company as dividend, the shareholders would have invested elsewhere. No, they would have also earned returns on that. So therefore, the cost of retained earnings is in fact an important component in calculating the overall cost of equity of a company. We cannot ignore this. Just like we calculate cost of debt, cost of equity, we have to also consider cost of retained earnings. So therefore, here in this case, option B is in fact the right answer. Because it reflects the return that the shareholders anticipate, right? Receiving on their, let's say, investment in the company's equity shares. This expected return is based on factors such as the company's historical performance, future growth prospects, and overall risk associated with the company's shares. Okay, and obviously this is not option C, that is risk-free rate of return, because it is the rate of return on the investment that is considered to have no risk at all. So like as I said earlier, the treasury bills or the T-bills or fixed deposit, in such cases there is no question of risk because we know that much we will anyway get. And dividend yield ratio is nothing but the ratio of dividend per share to the market price per share. What is the market price and what is the dividend which the company is declaring? So it also doesn't talk about the cost of retained earnings. So yeah, that's about question 10. Let's move on to question 11. Okay, Sharon has answered option C. Okay, yeah, correct answer. Next, question number 11. Decision rules based on benefit cost ratio, BCR, and net benefit cost ratio criteria implies what? If BCR is less than 1, accept the project. If net benefit cost ratio is less than 0, accept the project. If net benefit cost ratio is more than 0, reject the project. If BCR is less than 1, reject the project. So now which one is the right one? Let us look at each of these one by one. Option A. BCR is less than 1, accept the project, they say. This statement is obviously not correct. What does the BCR do? Or benefit cost ratio? It only compares the present value of the benefits to the present value of the cost. Let's say if the BCR is less than 1, it indicates that the present value of the cost exceeds the present value of benefit. That means we are spending more compared to the benefits which we are getting. In that case, why would we accept the project? We will not accept the project. No, we will actually reject the project. So this is obviously not correct. Then let us look at option 2, which is if NBCR is less than 0, accept the project. See, net benefit cost ratio or NBCR, what does it do? It compares the present value of benefits to the net present value of the cost. Again, if the NBCR is negative, what does it indicate? It only indicates that the net present value of the cost in fact exceeds the net present value of benefits. Why would I even accept such a project? Okay, so here also we will not accept such a project. Then if NBCR is more than 0, reject the project. Again, this statement is incorrect. Why? What does this mean? This is the exact opposite of the previous one. It implies that if the net present value of any project or anything which the company wishes to take up. If it exceeds the net present value of the cost, it is only a positive benefit, no? That means we are getting more returns compared to the cost. So that means if something is generating us positive returns, we would rather accept it than rejecting that project. So therefore this is also not making sense. So the last statement is about if BCR is less than 1, reject the project. So this in fact is correct, because as we saw earlier, BCR compares the present value of benefits to the present value of cost. And if the benefits is less than the cost, so that means it is less than that is number 1, then it obviously indicates that there is negative returns here. So if that is the case, reject the project, and that is in fact the right answer. Option D in case of question number 11 is the right answer. Okay, let's move on. In the exam, these type of questions are confusing. This is as good or as bad as a practical question, because it requires some kind of thinking, because just by looking at it now, after you look at it thoroughly, it can look very easy, but in the exam when you are tensed, then it may be difficult for you to come to the right conclusion. So be careful when you are attempting these type of questions. It is no less than any practical question. That's how I would look at it. Let's move on to the next one. Okay, an equity share with beta greater than unity would be called dash. Okay, so let us look at the option. A defensive stock, because it is expected to decrease more than the market increase. Okay, let's do one thing. Let us analyze each of these options once again. See, the reason why I am analyzing each of these options is, if I directly go to the right option, you will not understand as to why the wrong option is the wrong option. So in the exam, it is also important for you to understand why something is incorrect. Sometimes what happens, you may not know the right answer, but you may know that a certain option is not the correct option. So in such cases, what you can do is you can probably use the negative elimination and probably arrive at the right answer. So that way it is important for you to understand every option, at least while revising the question papers. So don't just look at the right option and move ahead. Also try to understand what exactly the wrong options are talking about, because in the exam you may get a question based on this option only, which is incorrect. Anyway, let's analyze the options. Option A, this statement is obviously incorrect. Why? Because a defensive stock is usually associated with a lower volatility and is expected to decrease less than the market during the market downturns. That means if the market is losing 100 points, this defensive stock will probably lose 50 points. Okay, so here we are talking about an equity share with beta greater than unity, greater than 1, unity 1 obviously. So a stock with beta greater than 1 is actually considered to be an aggressive stock, and it will in fact have larger price movements in the same direction as the market. That means if the market falls down by 100, this will also fall down by, this will actually fall down by more than 100, and if the market goes up by 100, it will go up by more than 100 points. So therefore option A is definitely a wrong option. Now let us look at option B. An aggressive stock, okay, an equity share with beta greater than unity would be called an aggressive stock because it is expected to increase, where did I go now? Because it is expected to increase more than the market increase. So this is in fact the correct statement. Why? Because as we just now saw, it is an aggressive stock. Why? Because the beta is more than 1. If the beta is more than 1, what does it do? Its responsiveness will be far more compared to the market upswing or downswing. If the market increases by 5 points, this will increase perhaps by 15 points. If the market goes down by 5 points, it will probably go down by 15 points. So therefore it is called an aggressive stock when the beta or the sensitivity to the market movements is more. It is more than 1, more than unity. See, they have very carefully worded the question. More than unity, they say. They could have simply said more than 1, which would have been easier for us to understand, but they have said more than unity or greater than unity. So in fact, this is the correct option. We can just look at these two options, that is option C and D. A defensive stock because it is expected to increase more than the market decrease. Again, this statement is also incorrect, because what is a defensive stock? You can say defensive stock is a stock which is characterized by its ability to what withstand market downturns and decrease less than the overall market during the periods of market decline. That means if the market declines by 100, this defensive stock will not decline by 100, it will decline perhaps by 30 or 20, because it's a defensive stock. Okay, it cannot have beta greater than 1. Okay, so that is obviously wrong. Then the last option is an aggressive stock because it is expected to decrease more than the market increase. Again, this is also wrong, because how can we expect it to decrease when the market is increasing? So that is also an incorrect option. So therefore the right option in this case is option B. I hope it makes sense. If you have any doubts, please do ask. Moving on. Yeah, we looked at 12th question now. Okay, let's look at question number 13. An interest rate that has been annualized using compound interest is termed as dash. This is very easy because we have already solved a problem based on the exact same question. We solved a practical problem based on this question earlier. So now the same question is asked again, but a theory question is asked. Okay, so let us look at it. What is the answer? An interest rate that has been annualized using compound interest is termed as what? It is nothing but effective annual interest rate. We already solved the problem. Remember question number 6, where we didn't get the answer, which was according to the options, where I said that I will take a look into this in the next session. The same thing is asked here. Okay, so now what is this effective annual interest rate? This is nothing but the interest rate that has been annualized using compound interest. That means it reflects the total interest earned or paid over 1 year, considering the compounding factor. That's all. Simple interest, for example, is not that, because there is no question of compounding at all in case of simple interest. Here they have very clearly mentioned compound interest, annualized using compound interest. In simple interest, you will always get the interest only on the original principal. There is no question of compounding over time. If 100 is the initial investment, and let's say the interest rate is 10%, you'll always get 10% on that initial investment of 100 rupees. Whereas in case of compounding, you know how it works. 100, then first year I get 10%, then it will be 10 rupees, then again my investment will increase to 110, on that I'll get 10%. That is how compounding works. Then discounted interest rate is also not something which works here, because it is nothing but the rate that has been reduced or discounted from its original value. It is specifically not related to compound interest. Then we have the annual interest rate. It is nothing but the interest rate which is charged or earned, depends on whether you are borrowing money or lending money, on, let's say, an investment or a loan over 1 year period, because we are only worried about the annual interest. So this also does not specifically imply that interest has been compounded. So the correct option in this case is option B, which is discounted interest rate. Okay, Priyan has in fact answered correctly. Let's move on to question number 14. Okay, what is this now? The risk aversion of investors can be measured by dash. Risk aversion, that means they're worried about the risk. How do we measure? There are 4 options as usual. Risk-free rate of return, market rate of return, variance of the return from a security, the difference between the market rate of return and the risk-free rate of return. Again, these type of questions are very difficult to answer unless you have already studied. In the exam, if you look at this for the first time and try to understand what is what, trust me, it is very difficult to answer, because you will get confused. So I would suggest, please try to revise this type of concepts as soon as possible. First of all, let us try to understand the options. What is risk-free rate of return? It is nothing but the rate of return on investment that is considered to be risk-free, or something which does not have any risk at all. In fact, as we saw earlier, treasury bills, fixed deposit, all these are risk-free returns. In fact, it serves as a benchmark for assessing the expected return for investments with higher level of risk. See, the risk-free rate of return is a relevant measure, but it does not directly capture the risk aversion of investors. Just by looking at risk-free rate of return, we will not know what is the risk aversion, how much the investor is afraid of the risk. Aversion doesn't mean afraid, but how they want to avoid it. So this obviously will not tell us. Then we have market rate of return. See, market rate of return represents what? The overall rate of return earned by investors, let's say in a particular market or particular asset class. It in fact reflects the, let's say, the collective performance of all the investments in a market. So how will this tell me about the risk aversion? This will also not tell me about the risk aversion. Okay. Then we have variance of the return from a security. So this is where we measure the risk aversion. Okay. Because what is risk aversion? Risk aversion in fact refers to, let's say, the preference of investors for lower levels of risk and higher levels of certainty in their investment outcomes. I want to have low risk investment. I do not want to invest in something which is very risky, but I want certainty in my investment outcome. That means I want to be sure that I will get so much. I don't want higher risk. I don't want higher returns. So now what is this variance? Variance is nothing but it's a, you can say a statistical measure that tries to quantify the dispersion or the difference or the variability of returns from a security or investment. It in fact captures the degree of fluctuation in the returns and serves as a kind of a level of risk associated with the, it tries to identify the some kind of base for the level of risk associated with the investment. If there is too much of variance, that means there is greater risk. If the variance is very little or low variance, that means it is low risk. So therefore, the best measure for risk aversion would be variance of the return from the security. Like if it is varying too much, that means it's a volatile security. That means we cannot invest in such a security. Okay. Yeah, that is the thing. We'll have to stop here now. We have solved 14 questions so far. We will continue this next week. We will have week-long sessions of both FM as well as CMA. Tomorrow also, let me remind you, there will be a live session on CMA. Wherever we had left in the previous session, we'll be continuing from there. But tomorrow, the timings is slightly different. We'll start at 4 p.m. instead of 5 p.m. So see you tomorrow. If at all you have any doubts regarding this, please leave a comment below. I'll try to get back to you. Thank you. See you tomorrow.